Okay, so you think you understand the stock market. You picture a room of people buying shares in companies, believing in their future, waiting patiently for that belief to pay off. That is the story, and it is not entirely wrong. Companies list, people invest, prices move on earnings, and hope. Here's what that story leaves out. Less than a third of the volume moving through the market today has anything to do with a human deciding to bet on a company's future. The rest is code, executing trades in millionths of a second, holding positions for less time than it takes you to blink. What everyone believes is a marketplace for ownership is actually a high-speed machine for extracting tiny repeated edges, and the reason is a decades-long shift from investing to infrastructure. $900 billion in daily US equity volume moves through this system, and most of it never touches a human decision. Here's what we're going to prove piece by piece: where this machine came from, who actually profits from it, who gets quietly left behind, and what happens the day it breaks. So, where did this actually start? The New York Stock Exchange began in 1792 under a buttonwood tree, 24 brokers agreeing on a simple rule: trade with each other first. For nearly 2 centuries, that meant floor traders shouting orders, physical paper, human judgment on every transaction. Then, in the 1970s, exchanges began digitizing. By the 2000s, speed itself became the product being sold. Now here's what it costs to compete in this new market. Firms pay staggering sums just to place their servers physically closer to exchange computers, because a few feet of cable can mean a few nanoseconds of advantage. That advantage is worth billions. This isn't one machine, it's a taxonomy. Index funds moving in slow, predictable waves, retail brokerages routing your order behind the scenes, and high-frequency firms sitting in the middle of every trade, taking a sliver most people never notice. And here's how the money actually flows. The visible layer is commission-free trading, the thing every app advertises. The overlooked layer is what happens after you hit buy. Your order isn't sent straight to an exchange. It's sold, routed to a trading firm that pays your broker for the privilege of seeing it first. The high-margin afterthought, the papasinin, the part nobody markets, is data. Exchanges sell real-time price feeds to hedge funds for millions a year. Feeds too fast and too expensive for you to ever access. So, what's silently draining you while this looks free? Spread costs, tiny gaps between buy and sell prices, bleed pennies from every trade, multiplied across billions of shares. And here's the mechanism nobody sees. High-frequency firms detect large orders forming and trade just ahead of them. A legal practice called front-running by speed, not by information. The market isn't rigged in the criminal sense. It's just faster than you, permanently by design. Now, watch what this machine did to 2 real players. Citadel Securities built a systematic trading engine so precise it now handles a quarter of all US retail stock volume, quietly becoming one of the most profitable trading firms on earth by processing other people's orders at scale. Meanwhile, Knight Capital, a firm that had thrived for years, making markets the old way, deployed a software update in 2012 that malfunctioned for 45 minutes. In that window, it lost $440 million, more than the company was worth, and Knight Capital ceased to exist within days. It looked stable that morning. Structurally, it was one bad deployment away from zero. So, where does this actually go from here? In one future, retail investors keep trusting index funds. The slow and steady layer absorbs more of the market, and the machine grows quieter and more entrenched. In the other, 3 ordinary things go wrong at once: a software glitch, a liquidity panic, and a regulator asleep at exactly the wrong moment, and the market seizes for minutes that feel like hours. So, the next time you tap buy on an app and watch the price update instantly, understand that convenience is not access, and speed is not fairness. The stock market was never really about ownership. It was about who gets there first. One future keeps rewarding the fastest machines quietly, forever. The other proves in one very bad afternoon that speed without oversight is just a countdown. 24 brokers once agreed to trade with each other under a tree. Now the trade happens before you finished reading the price.